Interest rates are skyrocketing. Mortgage rates are up over the 7% mark. 10-year Treasury yields are up almost 70 basis points just in the last few weeks.
The surge in mortgage rates that we've seen lately is the equivalent of a 6% increase in a home's price from a monthly payment perspective.
We could get rates moving back toward 5%.
So the next question becomes, how high will interest rates go? I'm going to reveal the answers for you, or at least my opinion on the answers, in 3 simple, fast steps. Step number 1, let's go over the 2 schools of thought as to what drives interest rates along the curve. We'll use the 10-year Treasury as a proxy. Is it the supply of treasuries being issued, or is it growth and inflation expectations? I drew up this chart. I kind of oversimplified it by making the lines perfectly straight, but the editors will reference the original charts as we go through this, going all the way back to 1980 to 2020. Now, in step number 2, we're going to focus on 2020 to today's date. On the left, we go from 0% up to 15%. This is applicable to the red line and the black line. On the right, we go from 0 all the way up to $22 trillion. This is referencing the blue line. So the blue line will start here, the U.S. federal government debt. All the way back in 1980, we're under $1 trillion. Call it 800, 900 billion. That's basically a rounding error compared to where we are today. Not just 2020, but where we are today, about 35 trillion. Again, more on that in step number 2. But from 1980 to 2020, so let's just call it 40 years, the debt went from about $1 trillion all the way up to $22 trillion. Now keep in mind, this represents not only the government debt, but the supply of U.S. treasuries. Because if the debt goes up, by definition, that means there's a deficit. Therefore, the government is going to have to issue more and more of these treasuries. So now let's go over to the black line and the red line. In 1980, they were both right around 15%. This would be the CPI as measured by the government and 10-year Treasury rates. And you can see they go straight down from right around 15% almost to 0% in 2020. So based on this chart, do 10-year Treasury rates follow inflation and growth expectations, or do they follow the supply of treasuries? It's obvious that they follow growth and inflation expectations. And you could argue there's actually an inverse correlation between these 10-year Treasury rates and the supply of treasuries the United States government has actually issued. So there is no debate here. It's obvious which school of thought is correct. And if you need further proof, editor, go ahead and throw up a chart of 10-year Treasury rates with nominal GDP. Because if you think about it, although it's not perfect, nominal GDP is a great way to quantify growth and inflation, because we're taking real GDP and using that as a proxy for the amount of economic growth, and then we're adding on whatever inflation we had, and that's how you get nominal GDP. So you can see by looking at this chart that even going back to the 1970s, when we had interest rates going up and up and up, and then since 1980, interest rates going down, 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 it's pretty much followed to a T nominal GDP in the United States. Step number 2. Now that we have established the main driver of interest rates at the long end of the curve is growth and inflation and not the supply of treasuries issued, let's go ahead and focus on what caused the consumer price inflation from 2020 to today in 2024 so we can determine the probabilities of a reacceleration of consumer price inflation in the near term or a continuation of disinflation where prices are still going up, but they're going up at a slower and slower rate. Now, before we get into the inflation that we've had recently, I know a lot of you right about now are literally screaming at your computer screen or your TV, your cell phone, wherever you're watching this video, saying, George, you don't know anything. You've completely lost the plot because don't you know that if the government spends more and more and more and more, and therefore they issue more treasuries, that in and of itself is going to create consumer price inflation and therefore drive up rates at the long end of the curve. There's a good argument. But let's go back to some of those charts that we saw in step number one. First and foremost, let's look at that chart of CPI from 1980 to 2020, and you can see it pretty much went straight down. While at the same time, the debt went straight up. So show me within this 40-year time frame when the supply of treasuries actually created a reacceleration of consumer price inflation. It didn't. And you can look at many charts that point to the exact same thing, not just the overall debt, but let's look at the debt to GDP since 1980. That went from about 30% in 1980 all the way up to over 100% just prior to the cerveza sickness. Let's look at the budget deficits. Back in 1980, 2.5%. Back in 2019, just prior to the cerveza sickness, 4.5%. And the deficits are massive now at over 6%. But I'd like to point out that after the GFC in 2011, as an example, the deficit to GDP was over 8%. So every single metric that you look at, whether it's debt to GDP, whether it's the deficit as a percentage of GDP, or the overall debt itself, has gotten much, much worse since 1980. But yet, inflation, or consumer price inflation as measured by the government, has come down from 15% plus at the end of 1980 to 2.4% today. So the bottom line is I don't think there's a very good argument for government spending or deficits leading to a reacceleration of inflation. If anything, they're anti-deflationary, as my good friend Lynn Alden says. All right, so let's get back to what has happened since 2020. Why did we have this consumer price inflation? And why have the rates at the long end of the curve gone up outside of the Fed jacking interest rates up to 5.25% at the front end of the curve? Well, first and foremost, let's look at M2 money supply. We all know what happened here. And this chart shows you the year over year change in M2 money supply as represented by this black line. And it goes literally parabolic during this cerveza sickness to a point where year over year, we were up over 25% increase in M2 money supply growth. Now, what's really interesting is you've got to look at the nuance because most people, they say, oh, well, it was the government spending. They were doing all of this quote unquote money printing. And that's what led to an increase of the amount of currency units chasing goods and services. But this isn't really true. You see, this spike higher was a combination of actually two things. Yes, it was the government or the Fed buying treasuries from non-bank entities through the process of QE. This definitely increased the M2 money supply. But it was also people drawing down their lines of credit. So if we go back to 2020 during this time frame, everyone thought the world was coming to an end. The government was locking people in a cage and they're forcing businesses to shut down. So these business owners didn't know when they were going to get revenue again. So they went to the bank and said, hey, that $100,000 line of credit, I need to draw that down. I need that $100,000 in my checking account ASAP because I want to make sure that I can survive whatever comes our way in the next few months. So this is an extension of bank credit. So if you look at the amount of bank credit issued during this time frame, you see that it also goes straight up. So why does this matter? Because if we go into 2025, and let's just assume we have a recession, is the probability high that the Fed will go from doing QT back to QE, and this could increase the M2 money supply? Absolutely. But I think that increase, especially if it's in response to a recession, will only be offsetting a decrease in bank credit. So if we look at that chart and zoom out, we can see that bank credit is almost flat since 2022. And it's definitely way, way, way below trend when you go all the way back to the GFC. Now, what was the next thing that contributed to the consumer price inflation we saw? Well, it was the way the government was spending money. They were taking from savers and giving that money directly to people with a high propensity to spend. In other words, stimmy checks. So, what are the chances we see that in 2025? Well, we have a recession. I think UBI is definitely, definitely on the table. But again, is this going to accelerate inflation or is it going to just offset what would have been deflation? In other words, anti deflationary. My base case is it would just be anti deflationary. It's a very low probability that we will get UBI or stimmy checks unless we go into a recession. And if you look at the history of recessions in the United States, they are disinflationary. Even in the 1970s, when we had a recession with a huge spike in unemployment, the inflation rate went down, did not go up. And then the last thing, of course, that contributed to the prices skyrocketing is the breakdown of supply chains. So the government locked you in a cage. They wouldn't allow you to produce goods or services. And then they give everyone stimmy checks. What do you think is going to happen? But what are the probabilities that these global supply chains break down in 2025, absent, let's just say, World War III, heaven forbid? I think the probability is very low. So the bottom line with this step is if we look at the things that contributed to the consumer price inflation from 2020 to 2024, I think there's a very low probability we see that outside of a recession in 2025. And if we do have a recession, whatever the central planners do to try to kick the can down the road, most likely will just be anti deflationary instead of inflationary to a point where inflation accelerates back up to, let's say, 7, 8, 9%, which is what we saw in the summer of 2022.
Step number 3. Now let's go over some other factors that a lot of people believe contribute to consumer price inflation, such as what if Trump wins, implements tariffs, therefore the price of the stuff that's being imported into the United States is going to go up. And by the way, most of the stuff you buy at Home Depot, Walmart, Target is imported from places like China. Well, or what about if Kamala Harris gets elected and does something stupid with energy policy, which is very likely, that takes oil from $70 a barrel all the way up to 100, 120, who knows, maybe even higher. We know that oil is an input to almost every single good we buy. Let's start addressing these issues by looking at a chart I drew up, not a real chart, just like step number 1, but it just gives you the visual. I'm trying to keep it super simple here. Let's assume for a moment this is a chart of bank credit in the United States. And most of you know the majority of dollars out there are lent into existence. So if we want to figure out what's going to happen with the money supply or consumer price inflation, which leads to interest rates going up or down, we've got to ask ourselves what is going on with the banks. What are they doing? And let's assume for a moment that bank credit has been going up and up and up and up. And it's gone from $0 up to, let's say, $9. Again, we're going to keep this super simple. It's all about the concept.
But let's assume for a moment we go into a downturn in the economy. The banks don't want to lend. And oh, by the way, the demand for loans goes down as well. So instead of bank credit going up at the same trend line, let's say it flattens out. And let's say we have a severe recession where bank lending or bank credit actually goes down to $5. So what we're doing here is we're using this bank credit as a proxy for the number of currency units that are chasing goods and services. And this isn't just a hypothetical. If you look at the recession we had in 2001 as an example, you see bank credit flatten out. If you look at the GFC, you see it flatten out as well, if not decline slightly. And during the cerveza sickness, or what we've seen over the last couple of years, we have seen bank credit at times go down and more recently flatten out and trend up slightly, but nowhere near the trend we saw prior to 2020. So the bottom line is, in this oversimplified economy, we only have $9. That's it. So let's go down here to everyone's favorite, the average Joe, and we'll say he is a representation of the entire US economy. So on his balance sheet, we've got assets on the left, liabilities on the right. We'll just focus on those $9 he has at his disposal. So every single month, Joe has to buy three things: oil, cotton, wheat. Oil's $5. Cotton and wheat, $2 each, which is perfect. That equals the $9 Joe has to spend. But what if Kamala Harris gets elected and the price of oil goes from $5 up to $9? Now we've got a problem. Because remember, banks aren't creating any more currency units. Bank credit is flat because let's assume we've gone into a recession, even if it's mild, and therefore the economy is contracting. Banks don't want to lend, people don't want to borrow. So now the cotton producers and the wheat producers have a problem because Joe has to prioritize this oil. He needs it more than he needs the cotton and the wheat. So what happens to the cotton and the wheat producers? They go bust. Well, what's interesting is oil was a component or went into the production of both cotton and wheat. So therefore, the demand for oil, once it goes up to $9, starts to go down because these entities went out of business, which oddly enough takes the price from $9, let's say back down to the $5 where it started. So if the banks aren't issuing more and more credit, if there's not more currency units being created, what you're doing by taking the price of one of these items, whether it's a result of oil, tariffs, same thing, you're basically robbing Peter to pay Paul. Because you don't have enough currency units to go around, you've got to prioritize your spending by taking spending away from something else, which makes those businesses suffer to the point where they could go bust. They lay off workers, unemployment rate goes up, aggregate demand goes down, which brings the price of whatever it is that was prioritized back down as well. But wait a minute here. Let's assume for a moment that we have a severe recession where the amount of currency units due to bank lending contracting go from $9 down to $5. What's the Fed going to do? They're going to come in and do quantitative easing. Absolutely, 100%. But if they do quantitative easing in a fashion where they're buying those treasuries from non-bank entities, we know that can impact M2, make it go back up. But it's not like it goes back up to a level that's going to create a reacceleration of consumer prices, meaning the CPI going from 2 to 4 to 8 to 10 and even higher. Because all they're doing is really filling a void that was created by bank lending decreasing to begin with. So the bottom line is, if we are trying to figure out the probabilities of interest rates going higher, staying the same, or going lower, we have to start by understanding at the long end of the curve, these rates are driven by growth and inflation expectations, not so much supply or the amount of issuance. Then we need to analyze why we had the consumer price inflation from 2020 to 2022 and ask ourselves, is that likely to play out in 2025? My base case would be no. And then finally, we need to get our head around this robbing Peter to pay Paul dynamic. And at the end of the day, I'm really just reiterating what Milton Friedman said so many times, that inflation is always and everywhere a monetary phenomenon. So if you don't have the banks creating more and more credit or lending more and more currency units into existence, it's very difficult, if not impossible, to have consumer price inflation, or at least sustained consumer price inflation, especially accelerating, just because Trump implements tariffs, or you have the price of oil going from, let's say, $70 a barrel to $120. So having said all that, my prediction, or my base case for the 10-year Treasury yield is, although we may see it continue to go up over the next couple months, if we fast forward a year, I think there's a much higher probability that the 10-year Treasury yield is trading at 3% or lower than 5% or higher. And the reason this is my base case is because I think if we fast forward those 12 months, growth and inflation expectations will be much lower than they are today. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.